borrowing. Of course, we might be keeping that to roll over various loans or maybe for working capital. But with this rating upgrade, would we want to retire some of this cash credit overdraft and then in lieu of that have more of CPs and NCDs, more of money market instruments than cash credit?
So practically, if I share with you, cash credit for us is proving to be the most cost-effective borrowing as of now, because with the latest or guideline before a few years where cash credit has to be hived off into 60% WCDL limit, which are rolled over every 90 days to 120 days depending upon our relationships with the bank. And we get the rates depending upon the rollover tenure, that is 90 to 120 days. So as in fact, the majority of our cash credit what we use is in terms of WCDL, which is rolled over every 90 to 120 days without putting any stress on ALM, because that is a carve out of our main cash credit. Having said that, the other thing why over a period of time cash credit will remain constant is because of the fact that RBI and banks are of the opinion that NBFC should borrow less in terms of cash credit. But in our case, even if we take cash credit at only as a 1 year, 10-year loan, we don't create any negative ALM. So we will be in a position to maintain or in terms of percentage reduce this cash credit over overall AUM. Because if you see this 1700 crores is constant since last 2-3 years, that is reducing the percentage of cash credit to overall borrowing. But that is because of the reason that it is more of a mandate that cash credit should be limited to a certain portion so as not to create ALM, but not from the point of view of a borrowing disadvantage. On the contrary, we have two advantages. That in cash credit being a floating limit, I can park my excess fund anytime in the cash credit account and use it. So I don't have any negative carry by investing outside the limit. And secondly, as I shared with you, that I get the advantage of rolling over.
Understood, sir. And the new geography, just last question, sir, the new geography that we have entered, what projects are we doing and what would be our aspiration to do future products which probably have not been added in the new geography?
We are a multi-product company, and any new geographies which we explore, we see to that how is the potentiality of the various products we operate in. And then with the way we built up our team and the way we have the business plans, few of the products are introduced there. Say, for example, in South we opened Hyderabad with a view to cater to the SME borrowers first, and then we will be introducing other products. Maybe in North also we started with SME product, and now we have slowly introduced commercial vehicle and will be doing two-wheeler also gradually. So whenever we open new geographies, we see to that what is the potentiality of the various products we operate in, and then we start with one or two of the products depending upon the team we build, and then the intention is to introduce all the products gradually.
Understood, sir. I'll come back in the queue, so thank you so much. Best of luck.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations for a good set of numbers. So my question was on, given the current environment where, all on the credit side we are seeing good growth and the environment is also pretty buoyant. Do you think, we can strive for higher growth in AUM by let's say 30-35%, or will we continue to focus on 20-25% kind of growth over the next year or two?
So as I told you, a 10-year is a medium-term view, and just to share with you, to do a 30-35% growth, there were so many enabling situations from the point of view of market size and macro headwinds from time to time. But being in the industry for more than 28 years now, I personally believe that even growing at around 20-25% is doubling your AUM every 3.5 to 4 years. And that is a tall order in a lending business if you want to prioritize quality and profitability both. And with companies like us who use a self-propelling capital requirement model, I think this is an ideal mix for us irrespective of the positive about the positive environment. So what we have done over all these years is that we have not got overexcited by the headwinds, nor have we bogged down substantially when there are challenges. So a 20-25% growth augurs well for a company, in my view, especially in the lending space. And that also is a tall order and a very decent growth you get by doubling your AUM and net worth every 3 to 4 years.
True, sir. And sir, on the rating upgrade, given the rating has now been upgraded to AA category, so, what on the liability mix side, how do you see this shifting over the next 2 years? Currently, the term loan is around 54%, cash rate is around 10%. So how do you, and the direct assignment and the rest of the things. So how do you see this thing shifting over the next year or two? What ideal mix would you like to have on the liability profile, and how is that expected to impact our cost of borrowing over the next year or two?
I think with rating upgrade, the major advantage will be in terms of touching the capital market. So our borrowing from capital market from currently around 10 to 12% should settle between 15 to 20% in next 2 to 3 years, depending upon the overall environment and the competitive rates we get. And plus adding on other institutes where we now start qualifying, financial institutes, now we start qualifying for getting credits from them. So in short, the idea will be to be less dependent on banks, increase our capital market exposure, try and explore other financial institutes who can now take exposures they've given our credit upgrade, accompanied by the reduction in rates. So very difficult to predict the exact configuration, but this is the line of this is the direction in which we'll be moving.
Sure. And on the bank loan side, given our rating upgrade, how much reduction in our interest cost do you see, on term loans and cash credit whenever they come for renewable over the year?
So, as for our bank loan majorly is linked to 1 year MCLR, and the spread or the renewal happens once in a year, or where we ask for a fresh enhancement from them. So we see that the impact of the cost of borrowing reduction coming in next 3 to 6 months, depending on the impact of MCLR on the cost of fund of banks.
By how much do you expect?
So we expect that our spread to be reduced between 15 basis point to 25 basis point in a 3 to 6 month period.
Sure. Okay. Thank you, and wish you all the best.
Thank you.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Good afternoon. Congratulations for strong numbers, and thank you for giving me this opportunity. So the first question is on the branch addition plan that we have and the targeted market and geography for FY25. Second question is on if you can share separately the DPD buckets of salaried PL as well as in CV, the CV book that we have.
Hi, Dhuvanil on this side. So if we talk about the geographical plan, as we have communicated earlier that we are pretty strong on the western side with almost 60 branches in Gujarat and 40 each in MP, Rajasthan, and around 30 branches in Maharashtra. So we'll be penetrating deeper into Maharashtra, Rajasthan, MP, number one. And number two, that we are planning, we have already started putting up our feet on the ground in north and south. So we expect that the incremental 20-30 branches that we are planning to add within next 6 to 9 months, I think around 40-45% of them will be from the north and south. So in south, Telangana, Karnataka, Tamil Nadu, these are the 3 states we are focusing upon, and in north, Delhi NCR and geographies above that. Going forward, I think incrementally you can expect on West, MP, Rajasthan, Maharashtra, and on South, 3 states, and North, 1 or 2 states.
Got it. And on the DPD buckets in salaried PL and CV book?
So, salaried PL is around 3.38 stage 3, 92% is stage 1. And CV, you asked for, no? CV is 4.12% stage 3 and 91% current portfolio, stage 1 portfolio.
Okay. Sure. And if you can just lastly, even on the yields, if you just, separate yields for CV book and salaried PL, please.
The SPL yield is around 21%, and SRTO is also ranging from 19 to 21%.
Great. Thank you so much. Best of luck.
Thank you. The next question is from Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and congratulations on a good set of numbers. Sir, on the housing finance side, we have seen a strong growth, but at the same time, I think the NPA numbers have been going up steadily as well. So, how do we see this sort of phenomenon to get normalized, and at what levels we should sort of see stable in numbers in stage 3?
On a smaller portfolio and a less seasoned portfolio, we were around 0.5%, and right now we are at around 0.6%. I think in the long run, we will see next stage 3 assets as a portfolio season, and especially in the borrowers whom we are serving, that is in the affordable space. We will see this housing finance NPS to settle anywhere between 0.8 to 1.2% going forward. And that will be in sync with our expectation on this type of borrowers. And just to add to that, in NPAs does not necessarily mean credit loss as far as housing is concerned, because we operate at a very conservative LTV. So ultimately, at credit cost will be at some 1% level in our housing finance company.
And in this sort of a low ticket lending in the affordable segment, while there is a security, but in terms of the capability to possess it back and sort of sell to recover your loan, is that on a practical basis? How does that work, and do you see any sort of a challenges on that front?
So there are 2 aspects to it. We don't work on any compromised titles. So the titles in our case are very clear. That is what I was sharing, that we took some time to develop our housing finance business because we wanted to understand the title dynamics in each of the geographies we operate in. So given that fact, the propensity to sell the property fast increases. But having said that, we never finance any of the properties with a view that we can repossess and sell it. So at the first instance, the credit is quite conservative. Second is, once we repossess it with clear title, it might take time, but we are in a position to sell it depending upon the geographies we work in, but quite sellable.
Okay. And on this, the expansion of the branches, so almost 40-45% was coming from your non-core sort of an area. Now, increasingly, as geography, the economy is getting bigger every year because of the growth and everything. West itself seems to be a large enough market for you at your size to be able to generate that 20-25% growth. So, what is leading us to sort of grow more in geographies? Is the current core geographies of, let's say, Maharashtra, Gujarat, is that not enough to satisfy, additional 1,000 crore, 1,500 crore that we need, 2,000 odd crore that we need for growth?
Hi, Dhwanil again here. As you said, yes, I think West has good potential. I think we are working in good states in West, lucky to be present here. The strategy in expanding in North and South is planning for the next 3 to 4 years. So we take our own sweet time in terms of developing the geographies and penetrating them more deeper in terms of tier 2, tier 3 cities. We take our time. If you look at our progression in, say, MP Rajasthan 3 years ago versus now, you will see that majority of the branches, 3 to 4 years ago, majority of the branches, almost say around 50% of the branches would have opened up in last 2 to 3 years. But we were present in MP Rajasthan, we are present in MP Rajasthan since more than 5 years now. So this is preparation for next 3 to 4 years, and we think that having a good diversified geographical mix also will help us going from 10,000 to 20,000 crores and trying to understand the demography, customer profile, business segments. So just readying ourselves for the future, and that is the reason that we are trying to penetrate and expand more into unknown territories, potentially unknown territories for us, where we have not operated earlier.
Okay. On the rating upgrade, this 15-20 basis point that we may gain in terms of our cost of funds, my assumption is that you will be passing it on, right? So keeping your ROA guidance broadly in the same area. Is that true, or is it going to be appropriated by us? So how should we look at your 2.75 to 3.25 ROA guidance? Will that see an upward revision with each rating upgrade? Because we are going to gain size with every few years, and that can also lead to some more rating upgrades a few years down the line.
I think when I talk about 2.75 to 3% ROAs, all these things is built in. So when we forecast that 2.75 at a particular place, and then we talk about 3% aspirational, the range bound ROAs, we built in all these aspects that the rating upgrade will happen, economies of scale will kick in, the direct distribution can add on to few more percentage, few basis point more in terms of ROA. So you are right in your assumption that we'll be concentrating our position between 2.75 to 3% ROAs with the rating upgrade.
Okay. And finally, right now we are at a 4 times debt to equity broadly. While we may not have an immediate need of raising funds, but given that our core engine is churning out 16% ROE plus there is some dividend, and then we aspire for maybe around closer to 25% growth. So to what leverage are we comfortable at a console level? So this 4 can max move out to what leverage level, and hence, by when we necessarily will need to raise funds? What will be the timeline?
So in terms of leverage, we will be comfortable at around between 4 to 4.5 or 4.6 in our parent company, which is well accepted given our track record in the market. And in the housing finance, it will be anywhere between 4.5 to 5%. And on the capital requirement, with 16%, close to 16% ROE is de-risking at around between 20 to 25% to assignment, 5% through co-lending and all. I think a growth of around 20 to 25%, take a mean of around 22.5%, will be a self-propelling growth. But having said that, as I shared, we already have an enabling resolution, and given an opportunity in terms of valuation and the right set of investors, we might infuse capital to further consolidate the balance sheet.
Understood, sir. Thank you and all the best.
Thank you.
Thank you. Participants who wish to ask questions may press star and 1. The next question is from Hardik Doshi from White Whale Partners. Please go ahead.
Okay, very nice.
Hardik Doshi from White Whale, you may go ahead with the question.
Yeah, just a quick follow-up, to the previous question on geographic expansion, where you mentioned you want to get into new areas because it takes a long time to understand the market. Similarly, are you looking at maybe entering any other newer products and like, trying them out, or these are the products that you're going to stick to for, let's say, the next 3 to 5 years?
So as we have communicated earlier, I think a carve-out from our current wheels portfolio will be the used car division. So used car is something that we are piloting with right now. And I think within next 3-4 quarters, it should start taking up shape, and that will be one more product which gets added to our wheels portfolio. We have already started deploying some team piloting, and we are trying to understand the market, and slowly and gradually we'll scale it up once we have the confidence and the full understanding. And as a subset of our SME business, so we can call it a sub-product. It will fall under the SME bracket, is the supply chain finance. So that is also a very good opportunity which we are seeing both in our existing customers and acquisition of new customers as well. So supply chain as a subset, but it will get combined with our SME piece only. But those are the two pieces which we are working upon right now.
Got it. And, maybe if from a geographic perspective, let's say 3 to 5 years out, how big do you see the north and south as a percentage of our loan book?
So I think in the next 2 to 3 years, I think it should contribute meaningfully at anywhere between 25 to 30%. That is what we anticipate within next 2 to 3 years.
And this would mainly be our Rajasthan MP because that's where we entered first, or you're talking outside of?
I'm talking about south. I'm talking about south and north. So 20 to 30% is the new geographies that we are currently working. That will contribute around 20 to 30% in terms of the overall AUM in next 2 to 3 years. Now west, I think Gujarat will lead the pack with around 40%. And Maharashtra, MP, Rajasthan will be equally divided at around 10 to 12% each.
Okay, so then that's a pretty meaningful growth in 3 years if you want to get to that level for just north and south, which is outside of our core, which is Gujarat, Rajasthan, and Madhya Pradesh and Maharashtra, right?
Mm-hmm. Yes, so I think that is why we are setting up early, getting our feet on the ground there, and we anticipate that the markets are good from our limited experience and from the peer reviews that we have done. I think the markets are huge for the products that we are operating in. So we can't ignore those markets, and I think if our retail distribution keeps on growing at the pace which it is growing at right now, I think that number is achievable.
Yes, but just asking the question which the previous participant asked in this context, right? Are you hitting any kind of constraints of growth in Gujarat, Maharashtra? Because our size, a 10,000 crore is nothing compared to the products that we are in, right? Mm-hmm. So again, why not? The geographies. There's very large market, addressable market. Why go into newer areas when there is so much room in our existing areas?
So, as you rightly said, there is good opportunity in the west, and that is why our expansion in the west is also happening at a good pace. So, as I had earlier mentioned, the number of branches that we opened up in western states other than Gujarat, the number has gone up sizably in the last 2 to 3 years. So we are not facing any constraint per se, but we are anticipating that the geographical diversification will be good, and getting ready for it early will be helpful rather than say at the 2 years down the line increasing the portfolio very rapidly in other states is something which has not been our way of working. So we feel that going a little early, and if you would have noticed that we had very minor presence in south around since 5-6 years now, but we were not growing it. So now we see that the opportunity is good, diversification of portfolio, and also increasing these western parts meaningfully in the next 2 to 3 years. We feel that this is a good strategy. But per se, if you talk about constraints, we are not seeing any major constraints in terms of growth. The major contribution still for this year and next year will be from the western part.
Okay, got it. Thank you.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
So thank you, everyone. And as shared by me and the team, that we are very confident going forward, and in consistence to our belief of consistent to our belief of growing fundamentally, we'll continue to work on the same line, and we'll be in touch. Thank you.
Thank you very much. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.